then currencies. The Australian dollar 89.60. Interesting to note, rising. Even in the wake of that CAPEX data here at home, showed a quarter-on-quarter drop of more than 5% and really did take the market by surprise. And the Australian dollar dropping about half a cent yesterday in the wake of that report. Let's pick that conversation up with Evan Lucas. He's joining us this morning from IG in Melbourne. Good morning, first of all, Evan. But tell us, I mean, how surprising is this move from the Australian dollar, especially in light of that CAPEX number yesterday, or is it more a reflection of what's happening, with the US dollar?
Yeah, well, that's the interesting question, isn't it, coming out of that today? We saw the core durable goods coming out over in the US, and they were really quite good. And that was, should have been US dollars appreciative if you have a look at it. Janet Yellen's speech was basically what she said before, just with different wording. So that was also there, and that should have been a known as well. What we can't understand at the moment with regards to those private CAPEX numbers is if you drill into it, if you look at the manufacturing expected investment over the next year and also the mining expected investment over the next year, that is the real concern. So if you look at manufacturing, it's dropping down from about $6.7 billion. Now, that is one of the lowest reads in almost 20 years for manufacturing. And then if you have a look at the mining investment, it's supposed to fall by 25% over the next year. So that is a huge chunk out of that forward CAPEX number. And that is a real concern because at the moment you can only see a 0.4% pickup in the non-mining space to actually offset any of that in terms of the capital numbers. So that is what is coming out of those numbers that we see as being a real sharp change. Now, if you also relate that to what the RBA expected, so if you go back to the original sort of quotation, there's always 5 changes to this. The one yesterday was the last one, but the original call for FY 14-15 was for around about $156 billion of private capital expenditure over the year. Now, the RBA expected that to depreciate by about 10%. So if you take yesterday's last final investment of $124.9 billion, that's an 18% decline. So that is a really big change in terms of what the RBA sees as well. So that again puts the Aussie dollar side of that equation back into really sharp focus. What does that mean? Are we going to have to start looking at how the Aussie dollar is priced and whether or not we see the current fair value, which is between high 89s, low 90s sort of handle, where it always has come back to over the last 2 weeks particularly, as being a bit of a high threshold, because at the moment there is no reason why manufacturing particularly can see an uptick in private expenditure because of that Aussie dollar. The non-mining space is certainly not coming into it either, and all of that is now playing into what happens Tuesday. So agreed with what you said, it's a very interesting situation with the Aussie dollar, particularly with that CAPEX number, which the RBA watches incredibly closely. What does that mean for Tuesday? Do they therefore start looking at their current statement? Because everybody is betting on the idea that rates are going to be stable, and that certainly is the idea, and I don't think yesterday will be enough to sway them. What do they do now? Do they change their statement again to try and put pressure and downward pressure on that Aussie dollar, or do they look at some other option to try and pull the lever from another way?
Well, I was speaking with Paul Bloxham, who's HSBC chief economist here in Australia, and he said he does not expect any more jawboning down of the Australian dollar coming from the Reserve Bank board, particularly in this statement. What would make you think that it might?
Yeah, and well, that's what we also see as well. Okay. This is that sort of catch-22, is that coming from what we saw yesterday, the private capital expenditure numbers are really worrying. They are certainly showing that we are slowing down faster than probably what the RBA even expected, faster than what most economists expect. Yet the RBA is probably at a situation where they can't jawbone anymore because there is this understanding from the market that they're not going to move on rates, that certainly that 2.5 looks to be the lowest. So what do you do now? How do you actually pull a monetary lever? Which, let's be honest, is a very blunt lever indeed. What do you do? How do you finesse that? How do you stimulate growth? And this also therefore puts another thing into sharp context, and that comes in the May budget. So a lot of the political talk, particularly the fiscal sort of monetary policy at the moment, has been very interesting. We know that the new installed government is really quite tight on what they're forecasting. They are certainly looking at cutting, but Joe Hockey is now having to walk on a very razor-thin wire that if he pulls too hard, you could really see that capital expenditure number falling away rapidly, and we would then have a situation where not only would you see a fairly large increase in job losses, you'd also see a situation where you would therefore have a very big slowdown in terms of the GDP numbers, and that is the other concern. So there is a lot of jaws. We understand there's obviously always a huge amount of variables when you look at these kinds of things, but yesterday's numbers are concerning, and that was one thing that we really need to watch. What do you do with the Aussie dollar? How does the RBA react? How does the federal government react to this? Do they therefore up their asset spending, particularly in the infrastructure side? Do they start to ramp that up as well? So there is a lot of questions that come out of yesterday, and I think that will be the most interesting development from a macro perspective over the next 6 or 7 weeks.
Yeah, when it comes to the markets, though, is that a huge concern as we move towards the May budget? Will there be volatility, particularly in the lead up to that time, because of the likely, flow-on effect, obviously, to Australian companies?
Yeah, and I think it will. And I think what you've got to look at is, again, what you've started to see now that you're also getting the China pressure story coming in as well. So iron ore is now basically sitting, again, making another lower low. There's also, some fairly bearish sentiment coming out of China with steel mills at the moment at a 3-month low. So they're actually making a 28 yuan loss for every tonne of steel. That works out roughly around about $4.60, $4.70 Aussie for every tonne of steel that they're producing. So they are in a loss-making situation. That puts in two perspectives. They either want to slow down the amount of iron ore they consume, or they want lower prices. So that will put pressure under your BHPs and your FMGs. And then if you have your infrastructure spending not coming through at the rate that probably some expect, that will also put pressure on places like small and medium-sized producers, also small and medium-sized providers. So watch your things like your Blue Scopes, watch your things also like Transfield Services. If you can also put in there Transurban, that are supposed to benefit quite heavily from these asset investments, particularly in Sydney. So there's a lot of change coming, and we do need to watch that quite closely. The market at the moment is really sort of getting to that 6.5-year high and asking the questions, are we going higher? At the moment, the bulls are being exhausted. We cannot see them pushing through. They lose all confidence, and the bears then take over. So it's a very interesting time in the market at the moment, Nadine.
Okay, and we'll be following every move today with you as they happen. Evan Lucas, thanks so much for joining us. Appreciate it.
Thanks, Nadine.